Good afternoon, and welcome to the Wealth of Advice Market Update on the 16th of May 2020. Just trying to start off by going through some of the key stories which came into the news this week. Last Sunday, Boris spoke to the nation, albeit from a video recording, which I thought was a little bit disappointing that there was journalists and such like stood outside Downing Street with live written all over the news channels, and then it went straight to a video that he'd recorded earlier that day. There was a lot of ifs, buts and maybes in the presentation that he gave. People weren't really clear about what could and couldn't be done. However, we have started to see a lot of companies preparing to return to work all over the UK, hopefully trying to get back to some kind of sense of normality. And from the point of view of what we're talking about here really is investments and fund performance. Hopefully that'll start feeding into some positive growth. Everyone's talking about this huge recession that's likely to happen in the coming months. Well, the best way to stop that is to get companies working as best we possibly can. Ultimately, we'll not be able to return to work fully, and the pre-crisis normality won't return until we get some kind of vaccine, or at least some kind of medicine that can help people who suffer from the illness. There was positive news on that front this week. Swiss company Roche announced that they have been testing a vaccine on monkeys, and of the monkeys that they were testing it on, I think they weren't getting pneumonia compared to the ones the ones who were getting the test vaccine on weren't getting pneumonia, whereas the other ones who didn't have the test vaccine were. So they said that is shown that it is effective, and that's definitely something to be positive about. So once we start getting more down the line with that, then again markets might recover and markets might respond positively if we think we're coming towards getting a positive solution. Expected announcement on Brexit was supposed to happen on Friday afternoon. There wasn't really nothing announced other than that the two sides are still at loggerheads. We spoke with Roy London about Brexit. I'll come on to that a little bit later because that's going to be very important as to what might happen with funds and markets going forward. Across in America, Donald Trump been at it again all week, really ratcheting up again his desire to sort of blame China for everything that's gone wrong here. He threatened to cut off the whole relationship with China. Everything's looking very insular in the US. They said that any drugs that they are going to create or make over there would be made in the US, provide US people first. Yet on the flip side of that, they were demanding a French company supply any medicines to the US if they came up with them. So very strange what's coming out of Washington right now. Trump also guaranteed the American people he would have a vaccine by the end of the year. Scientists don't like this at all because you can't promise a vaccine, because anything that's been tried and tested, it could be setbacks. You might need further studies. So overall, the news stories that were coming out this week didn't provide much positive news that the markets liked. We had some up and down days as the week went on. We saw like -3% days again, but then on Friday the markets finished up. So it's really a topsy-turvy time. We've just shown the graph there of how the markets have performed over the last couple of weeks. As you can see there, the FTSE All-Share, the UK stock market, is down 0.25% over that period of time. I'd be comfortable sort of seeing slight increases, slight decreases, as I said last week, over the next few weeks. The Japanese index there is the airline, that the blue line at the top. That's had the best performance over the last couple of weeks. That shows you that they're doing something well over there. I think overall with the UK market, why it didn't go up this week was because of Boris's statement being a little bit not clear cut, and some of the messages given there had to be re-explained. I think one of the things he said was, for instance, everyone should start work again on Monday, and then Monday morning it was like, no, we actually meant Wednesday. So there should have been a little bit more put into that, but hopefully markets will start to respond over the next few weeks as people do get back working a little bit longer. Wanted to just provide an update on the what Wealth of Advice have been doing this week. I think we'd said previously that we were starting to get more staff coming back in the office. Still have some people working from home and a few on furlough, but we took the opportunity this week, myself, Nasha, and Natasha, to have an investment committee meeting. We're expected to have one of these every month, recorded every month by our investment process. But we do speak regularly. However, we formalised a committee meeting this week, looked at all the different asset classes where we invest clients, looked at the position of all the portfolios, and try to sort of ask hypothetical questions about what may happen in the future. Are our funds positioned as they should be? Is there any funds we should be watching out for? And on that point, we have created a watch list, which we've had for a number of years, but we updated the watch list this week, and there was an extra 2 or 3 funds which we put on there. There was one particular fund manager retired during the week, so we want to see what's going to happen with his fund going forward. There's another fund, a bond fund that we use with a particular company, where their performance has been really off the scale negatively compared to everything else in that sector over the last 6-8 weeks. So we're looking at what's happening with those funds, and if we are going to make any changes, we'll recommend those in the coming weeks. There's nothing there which is sort of raising alarm bells as to sort of we need to get rid of something immediately, but there's certainly a couple that we want to keep a closer eye on. On the back of that, we then arranged some remote meetings with, again, several fund management groups to speak directly with fund managers. And as I say, that was good. We got a lot of good information from those people, and it's definitely interesting to hear different people's views on how things are going. In previous presentations, I've focused a lot on how the risk score 2 and risk score 3 portfolios have performed. Well, this week I'm putting in more to do with the Royal London portfolios. We have around about £30 million of clients' money invested in various Royal London portfolios, and their governed range is managed by mainly a guy called Trevor Greetham, but there is a whole team who work around Trevor, and we were able to speak with one of the sub-fund managers on Thursday. And he explained that the performance of the Royal London portfolios, when they were comparing them to other portfolios in the sector, haven't looked quite as good. And that's simply because they've always had more of a focus on investing the main bulk of their assets in UK stocks and UK bonds. They don't really have a huge exposure to overseas assets within their portfolios. They believe that gives them or they can say, as a result of having more in the UK, that their funds are more cautious as a result, which is part of the reason why we use it, and it's part of the reason why certain clients are recommended to go into those funds. So naturally, when other markets around the world have increased, and a couple of slides ago I showed it, as I say, the Asian markets and the US markets had done better than the UK ones, then these portfolios won't look as good compared to the rest. That doesn't mean to say that we need to get rid of these portfolios, but we are obviously talking to their fund managers just to make sure we're comfortable with what they're doing. And we are with Royal London. We don't have any concerns about their sort of tried and tested method. They've been managing these portfolios in the governed range for the last 11 years, and they've done very well over that time. So this graph here, to compare it to ones we've shown in previous weeks, is showing that notional £100,000 invested towards the end of February, how much it would be now. And the governed retirement income portfolio 4 down minus 9.87%. The slightly more cautious one, which only has around about 30% in equities, stocks and shares, is down minus 0.78. The governed portfolio 5, which has around about 60% in the stock market, that's down minus 10%. Obviously, over the longer run, when things bounce back, we would expect the riskier one to bounce back higher. So overall, 10% down still since the end of February for the Royal London portfolios, very similar to the risk score 2 and 3. So as I say, we're just keeping a close eye on them. Royal London for years have produced this investment clock, which their fund managers swear by. The red dot you can see just down from the centre of the circle there is where they believe we are right now on the clock from an investment point of view. The best and most ideal place to be, in their opinion, is in the top right-hand corner. But it's certainly not in a bad place right now. The market has fallen and it is coming back. We're not quite yet in a recovery stage. The key parts of the portfolio that they think that you should be overweight in right now are the lowest risk areas: bonds, government bonds, and such like. As soon as that red dot moves up to say that stocks and Stockland shares should be the place where you have an overweight position, they'll certainly move that. And as I say, given their 11-year track performance of doing this, they very rarely get it wrong. So we were comfortable with how they explained where they think they are in world markets. Everything in the markets are right now. So, who remembers Brexit? Only a couple of months ago, it was on the news virtually all day, every day, similar to what the coronavirus news flows like now. There was a meeting between the UK and our EU counterparts yesterday, and nothing really has been decided. However, one of the things that the Royal London Fund Manager was explaining to us is that he thinks that there could be some positive moves with this in the next few weeks. Prior to the coronavirus really affecting everyone and mass unemployment increasing as it has done, there was certain parts of the Eurozone that had really high unemployment levels anyway. With the expectation that we're going to have a deep recession that could last a long time in certain areas, he believes there won't be much appetite from the Europeans to do something negative with the UK, given how strongly they need us for the amount of exports that come out of the EU into the UK. So he doesn't believe that they're going to start slapping tariffs on their products, our products going in, and vice versa, because that would only worsen their problem. So he thinks that from both sides, there's got to be sort of a realization that we need each other, and therefore a deal will have to be struck at some point during 2020. Remember, we are in that transition period. A leave date has already been specified, and there's no real change on that. Theresa May was obviously in a situation where she didn't have a leave date confirmed, and there was these ifs about what might happen, and it appeared that the Europeans had her over a barrel. However, now we're in a position where Boris pushed through the legislation in January, and now, as I say, we've got a clock that's ticking. So hopefully a deal will be signed soon, and we think that could have a very positive impact on UK-based investments. If we look at how the pound has done over the last few years, certainly since the Brexit vote first happened, when the pound fell off a cliff back in 2016 as a result of us deciding to leave the European Union, it has had some moments in the interim period where it has come back. It got back above $1.40 at one point. However, if you look only the last few weeks, it went down, I think, $1.13. It's now back to $1.21 yesterday. So it's very, very weak against the dollar. Against the euro, again, exact same story. Fell massively against the euro in 2016 and never fully recovered. Again, earlier on this year, when I think it was the end of January, when we confirmed what was happening in respect of the transition period, then the pound did have some kind of rally, but again, it's fallen again. If we were to sign a trade deal with the EU, the pound will strengthen. If the pound strengthens and we feel that we've got a good deal, then markets should respond positively as well. The other thing about the currency markets, which we're reading this week, was explained that because Boris's announcement on Sunday night wasn't full of exact rules, and this will happen, that will happen, the roadmap how we get out of this crisis wasn't really laid out as perhaps some had wanted. That caused a sell-off of sterling as well. And whenever people are really worried about currencies, then the dollar will rally and the dollar will be strong. So the dollar is strong to the pound at the moment. And the other thing the Royal London guy was saying with regards to the European Union and why the euro may weaken against the pound in the coming months, maybe in the next year or two, is the fact that the European countries have fallen out with each other. The Germans and the Dutch appear to be getting really stronger in respect of their currency, whereas the Spanish and Greece, they're part of a single currency, which is really too strong for what their actual economy is. So as that unfolds, the Italians are very upset with what's going on within Europe and how they were treated at the beginning of this crisis. So we might see movement on that. or what a lot of people looking at this might be thinking as well, is if we do get out of this situation in the next 6-12 months and we are able to travel on foreign holidays again, then you might get more money in your pocket when you are exchanging money. However, from what we're looking at, it is important for how overall UK investments fare. As I say, going back to the Royal London slide where we said they have a lot of focus or a lot of their asset allocation in the UK, a weak pound hasn't really helped them that much overall. That was everything we had to go through for this week. Again, just like to ask if anyone has any questions, please get in touch. Wealth of Advice is back operating as best we possibly can. We do have staff members in the office either mornings or afternoons, so if at any point you ever needed to get in touch with us, there should be someone there. We will be starting to get in touch with clients again who we had suspended doing review meetings for during the month of April, and we will be looking to get those certainly put in the diary to do something over the phone or send out by post, or even invite you in for a meeting where you can come in and sit in our downstairs office. So thanks for listening again. I hope I'm back next week with a positive update. So take care.